Imagine you're 18 years old. You've never signed a lease, never had a credit card, never negotiated a salary, and someone hands you a form that says, borrow $50,000, maybe $80,000, maybe more, and you do it. Because everyone tells you it's the smart move, because the alternative feels like falling behind before you've even started, because you trust the system that built the form. Now fast forward 10 years. You have the degree, you have the job, and you still owe most of it. Student debt isn't new, but what's happening right now, the scale, the structure, and the quiet acceleration underneath the surface, that part isn't getting nearly enough attention. Because this isn't just a personal finance problem. It's a slow-motion wealth transfer, a generational squeeze, and a financial trap that was designed at almost every level to be difficult to escape. Let's talk about how we got here, and why the worst of it may still be ahead. How education became a debt machine. Go back to the middle of the 20th century. Higher education in most Western countries was either heavily subsidized or nearly free. The idea was straightforward. An educated population was a national investment. Governments funded it because they expected to get it back through tax revenue, productivity, and economic growth. That logic made sense. And for a while, it worked. Then, gradually, the funding started shifting. Government support for universities began declining. Schools compensated by doing the one thing they could, charging more. And what made that possible, what kept the whole thing from collapsing immediately, was the expansion of student loans. Student loans didn't just fill a gap, they created a new dynamic. Universities knew that students could borrow to pay whatever was asked, so prices rose. And because prices rose, students needed to borrow more. And because more students were borrowing more, universities faced even less pressure to control costs. This is the loop that nobody wanted to name out loud. Easy credit doesn't make education more accessible. It makes education more expensive, and then it makes debt more permanent. In the United States, total outstanding student debt has now crossed $1.7 trillion. That's more than all credit card debt in the country combined. In the UK, the average graduate leaves university owing around £45,000. In Australia, the national HECS help debt is accelerating as indexation rules push balances higher faster than many borrowers can repay. This is not a uniquely American story. It's a pattern playing out across every country that decided education should be funded by the people consuming it, rather than the society benefiting from it. The numbers that don't add up. Here's where the math gets uncomfortable. The underlying promise of student debt was a straightforward trade. Borrow now, earn more later, repay over time. The degree increases your income enough to justify the cost. Clean, logical, defensible. Except the earnings side of that equation has not kept pace with the debt side. Over the past 3 decades, tuition costs have risen dramatically faster than graduate wages in most fields. Entry-level salaries have stagnated relative to inflation, and the types of jobs that once required only a bachelor's degree now frequently require additional credentials, which means more time, more debt, and more delayed earnings. Meanwhile, the cost of everything around those first working years, rent, healthcare, has risen sharply at the same time. So graduates are entering a world where they owe more, earn proportionally less, and face higher costs across every other category of life simultaneously. And here's the part that rarely gets discussed: interest. Student loan interest doesn't sit still while you figure things out. On income-based repayment plans, many borrowers find that their monthly payments don't even cover accumulating interest, meaning their balance grows even while they make payments on time. The loan expands, and the borrower, technically doing everything right, falls further behind. There's a term for this in structured finance. It's called negative amortization. In mortgage markets, it triggered the 2008 collapse. In student lending, it's just called normal. Who it's actually hurting? When you look at the aggregate numbers, $1.7 trillion, millions of borrowers, it can feel abstract. The borrowers carrying the heaviest burdens are not, on average, the ones with the highest earnings potential. Studies consistently show that graduate and professional degree holders, doctors, lawyers, MBAs, tend to repay their loans relatively efficiently because their salaries justify the borrowing. The people most likely to default, to struggle, to have debt that outlasts their working years are those who attended college, borrowed to do it, but never finished a degree, or those who graduated with credentials in fields where compensation never matched the cost of entry. The system effectively punishes the people who tried, got partway through, and ran into circumstances, financial, personal, structural, that interrupted the plan. And then there's the downstream effect on everything else. Homeownership rates among people in their late 20s and 30s have fallen significantly compared to prior generations. Retirement savings contributions are delayed. Entrepreneurship rates are lower among high-debt graduates because starting a business requires a risk tolerance that's hard to access when you're already carrying a large fixed obligation. Even marriage and family formation patterns have shifted in measurable ways. This is how a debt problem becomes a macroeconomic problem. It doesn't just affect individual borrowers. It reshapes the decisions of an entire generation, and those decisions ripple outward into housing markets, consumption patterns, and long-run economic growth. The forgiveness trap. Every few years, the political conversation turns to student debt forgiveness, and every time, the same debate plays out. On one side, cancellation would deliver immediate relief to millions of borrowers, stimulate consumer spending, and correct what many argue was a structural injustice embedded in how education was financed over decades. On the other side, it's regressive in its distribution, disproportionately benefiting people with higher eventual earnings. It doesn't address the underlying cost structure, and it raises genuine questions about moral hazard and fairness to those who sacrificed other priorities to repay. Both sides contain real arguments, but neither side is asking the more important question. Even if every dollar of existing student debt were canceled tomorrow, every cent wiped clean, the system that created it would still be fully operational. The next entering class would borrow roughly the same amounts, under roughly the same terms, for roughly the same degrees, because nothing about the pricing structure would have changed. Forgiveness without structural reform isn't a solution. It's a reset that sets the clock running on the same problem. And politically, that makes forgiveness difficult to defend as a long-term policy, even for those who support it. Because the argument "we fixed it once, we'll fix it again" is not a policy. It's a promise that becomes harder to keep every cycle. What's accelerating underground? Here's what isn't getting enough attention right now. The student loan pause that began during the pandemic, in the United States specifically, suspended repayment obligations for millions of borrowers for several years. When repayment resumed, default rates climbed sharply. Millions of borrowers who had become accustomed to not making payments suddenly had to reintegrate a significant fixed cost into household budgets that had already tightened due to inflation. The transition has been rough in ways that official delinquency figures still don't fully capture because of the lag between missed payments and formal default classification. At the same time, graduate school enrollment has continued rising, partly because undergraduate degrees feel increasingly insufficient in a credentialed job market, partly because people facing a difficult entry-level labor market return to school, taking on additional debt to wait it out, and partly because universities have expanded graduate programs aggressively, because graduate tuition is less regulated and more profitable than undergraduate programs. So you have an existing stock of debt that's difficult to repay. You have a pause and restart dynamic that has stressed millions of household budgets, and you have a pipeline of new borrowing at the graduate level that's growing. The pressure is compounding, and the release valves, income growth, interest rate relief, political intervention, are uncertain at best. The global dimension. It's worth stepping back to notice how different countries have approached this, and what that reveals. Germany offers tuition-free university education to domestic and many international students. Norway, Finland, Sweden. Similar models. These countries made a deliberate political choice. Educated citizens are a public good, and the cost should be distributed broadly through taxation rather than concentrated on the individuals who pursue degrees. Their systems are not without problems. Access issues, funding pressures, mismatches between graduate supply and employer demand, but the debt burden graduates carry is structurally different from what American, British, or Australian graduates face. What the comparison reveals is that the current situation in high-debt countries isn't inevitable. It's a policy choice. The question isn't whether higher education can be funded differently. It demonstrably can. The question is whether the political will exists to redesign funding models in countries where the current system is deeply embedded in institutional budgets, political incentives, and the financial services industry that profits from loan origination. That last part matters more than it gets credit for. Student lending is not just an education policy, it's a financial product. And financial products have constituencies, investors, servicers, guarantee agencies, whose interests are not always aligned with the interests of borrowers. Understanding that dynamic helps explain why reform is harder than it appears, and why the system tends to persist even when its failures are visible. What this means going forward, there are a few scenarios playing out simultaneously, and they're not mutually exclusive. The first is slow attrition. Default rates rise gradually. Credit scores among younger cohorts stay suppressed. Homeownership and asset accumulation continue lagging behind historical norms for this age group. The economy absorbs it, not cleanly, not without consequence, but without a single dramatic crisis that forces a reckoning. This is probably the base case, slow damage rather than sudden collapse. The second is a political pivot. Enough electoral pressure builds, particularly as heavily indebted millennials and Gen Z voters age into peak political engagement, that meaningful structural reform becomes viable. Not necessarily debt cancellation, but changes to how institutions are funded, how interest accrues, how income-driven repayment actually functions. This is possible. It is not certain. The third, and the scenario that gets discussed least, is an institutional correction in higher education itself. If the labor market begins consistently signaling that credentials from certain types of programs don't justify their cost, enrollment in those programs falls, which pressures tuition, which forces universities to restructure. This is already beginning in pockets. Certain graduate programs are seeing enrollment declines. Some employers are quietly de-emphasizing degree requirements. The signal is early and faint, but it's there. The uncomfortable truth is that the resolution, whatever form it takes, will not arrive cleanly or quickly. These systems change slowly, and the people caught in the middle of the transition bear costs that rarely appear in policy papers. The student debt story is sometimes framed as a failure of individual decision-making. People borrowed too much. They chose the wrong field. They didn't research their return on investment carefully enough. And there's a version of that critique that contains a grain of truth. But it's a grain surrounded by a lot of structural reality. 18-year-olds borrowing to access an education system that society told them was mandatory for their economic survival, for their social mobility, for their futures, were not operating with full information, fully formed risk tolerance, or meaningful alternatives. They were doing what the system designed for them to do. The more productive question is never, why did people borrow? The more productive question is always, who built a system where that much borrowing became the only path forward? And what does it mean that we've been running that system for 30 years, watching the debt grow, watching the wages stagnate, watching the defaults rise, and the primary policy debate is still about whether to forgive the existing pile rather than whether to stop building a new one? Somewhere in that gap between the question we're asking and the question we should be asking, the next generation is signing the forms.